What's up, everybody? Chris over here, founder of Pollinate Trading, and continuing the series on prop trading. Today, we're going to be talking about risk. So let's get to it. As a reminder, here's your disclaimer. Past performance is not indicative of future results. Right. This is the free prop trading course. By the way, there is no paid prop trading course. This is it. This is the thing. All I ask in exchange of this is that you give me a like, subscribe to the channel. That way, next week, when I send the next video out, you can get notified and you can move along in the process. If you know somebody who's a prop trader who's struggling or needs some help or anything like that, forward this whole playlist on to somebody who needs your help. That's would just be the best for me. That would support me quite well. Keep me going on this little journey, and which I'm enjoying the heck out of this. So hopefully it's useful to you. And if it is useful to you, hit a like, hit a subscribe, share it out. Let's go. Okay. In the first video, we talked about why trade prop. Go check that video out. It's the first one in the series. The summary is size matters. If you can make 20% on a $5,000 account, that's about grocery money. But if you can make 20% a year on a $5 million account, now that's some real money. The reason you would want to trade prop is because you get the leverage from prop trading. Most traders are underfunded. The next one in the series is called You Need a System. Second video, we talked about why you need a trading system. Quick summary there is you know how to handle drawdowns. Handling drawdowns sucks. But if you got a system, then you got a pretty good idea of how it's going to work. So when it does go into drawdown, you can just carry on your merry way. Also, you understand if you're trading well or not, if it's you or if it's a system. And it'll keep you in the game over the long term, get you funded, and get you paid. Okay, today we're going to be talking about risk management. Now, this is something that everybody loves talking about. They'll also say things like DYOR. Here's my thoughts on the market and blah, 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 blah. But DYOR, do your own research. And you're like, well, how do I do that? What does that mean? I thought you just gave me something to learn and all that, right? Well, I'm going to do it differently. I'm going to tell you, use risk management. Risk management is the most important thing. Now let's figure out how to use risk management. I'm actually going to explain risk management to you and why stacking risk management on your systems gives you that understanding of how to stay in the game and how to get funded, how to get paid, and how to do this for a future. We're going to solve that today. So what is risk management? And this is the way I define it in trading, okay? It's how much you're allowed to lose. Our job is to trade our system without mistakes for a very long time so that our edge can be realized. And position sizing is the tool we use for that. I come from a background of high risk in other places, and it's very similar. You want to take calculated risks that you can step back from whenever you find yourself in a bad position. You can always move back, take a break, recover, and you don't blow up completely. You're not ambushed. You're not dead. You're not wiped out, right? So the first thing we're going to talk about is R, risk. And you'll hear a lot of traders talking about that term R. And maybe you've been wondering what the heck that means. Well, we're going to clearly define what R is for you here. And we're going to, now you can just follow along the conversation. In fact, you can just start tweeting, hey, I made 3R today. And hey, I'm up 10R on the month and all these sort of things. And people will look at it and be like, okay, cool, I get it. Instead of just saying like, yeah, I had a 99R day, when what you actually did was you made 99 points on like NASDAQ or something like that. And you didn't risk 1 point. You just made 99 points. So don't get yourself in trouble with somebody by false claims of those things. Don't get scared when other traders are talking about R, because it's actually a very simple term. R equals risk. In algebra, you put a letter where you want to store something and say, okay, R is going to be here. Now let's go solve for R. That's what we do here. R is the thing. How much money you're actually going to lose in a trade. That's what R means. If you made, let's go on. Okay, R is how much you can lose per trade. So for example, this is going to be the most busiest slide in math on the whole thing. And this is this is the thing you really want to know. Okay. If a stock XYZ is trading at $100 and your stop loss is $98, R equals $2. Okay. But that's one key element to it. But how much is R? If you have a $100,000 account and you risk 0.50%, meaning on a $100,000 account, 0.50% is $500, then if you were willing to risk $500, then you would trade 250 shares of XYZ, because if you got stopped out at $98, you would only lose $500. Does that make sense? That's why R is $2. So that tells you how many shares, how many contracts to buy of the product you're going to buy, so that if you take a loss, you lose that specific dollar amount. Now, on the other side of it, we're gonna come back and work through that sort of stuff a little bit better. But on the other side of that is your R multiple is how many times the risk you've traded. So if you had a trade where you made 2R, that means you had 2R. You've made twice your risk. So in our $500 example, 2R. What is S25? Where 2R equals $1,000, right? Because your risk is 500 times 2, that's $1,000. So what we're going to want to do is we're going to take that knowledge and solve or size your positions so that we can avoid your max drawdown. Remember, we're talking about prop trading in this course, and our biggest job is to avoid the max drawdown and breaking a rule in the market. Most prop firms now, the biggest rule that they have is just don't go below your max drawdown. And for this example, we're going to be looking at the $150,000 account on Apex. Each prop firm's different, but this one has a 3.3% drawdown. So if you have a $150,000 account, your max drawdown is $5,000. Okay. Now, on the last video, we talked about having a system and why you need to have a system. That should tell us when we backtest it and do the work on our system, we should know how many max consecutive losses we have. My system, max consecutive losses is 7. Okay, so that means 7 losing trades in a row. And by the way, it happens. It happens more than you think. A lot of people think that traders are just cool as ice and the best traders never have losing trades. It's my experience knowing some of the best traders in the world. Some of them have like a 20% win rate, 20, 30% win rate. But when they hit it hard and they load up. Some of them, like, me, I'm around a 40, 50, 60% win rate sort of trader. So I'm constantly getting stopped out. And when I really moved to the next level is when I started getting really good and really comfortable at taking stops. So in my math here, I don't want to optimize for the max, the shortest amount of days or shortest amount of trades to hit profit target. I want to make sure that worst case scenario, bad things happen, I don't blow up my account. In this case, yes, I have 7 max consecutive losses, but what I'm going to do is I'm going to do a margin of error of 15 max losses in how I size this. Okay. So my account balance, $150,000, max drawdown 3.3, and max consecutive losses is 15. So what I'm going to divide the drawdown by max consecutive losses. So 3.3% divided by 15 equals 0.20% risk per trade on the $150,000 side. If you're doing it on the risk side, you can size it differently. But that means that on a $150,000 account, I'm going to lose 0.20% or $300 per trade. Okay, that means if I had 15 losing trades in a row, then I would hit that 3.3% drawdown on that $150,000 account at $5,000. Right, 150,000 times 0.20, like I said, is $300 risk per trade. If I did 15 losers in a row, that would take me down to 49.50, 5,000 right there, and we're done. So in my back test and in live trading, I know that 7 consecutive losers in a row is very possible. Because of that, I just need to make sure that I size my positions so that even if I had 7 in a row, no big deal. In fact, if I have twice that plus an extra, I'm not going to blow up my account. So that'll allow me to stay in the account, keep going till I hit my profit target. And then I can get to the live account. And the same thing happens with live accounts. This isn't just for when you're in tryout. The same exact thing you did in tryout is the same exact thing you do in live trading. So I just want to be clear, by the way, it doesn't mean that you only buy or short $300 worth of an asset. So if you're, if on that stock example, you wouldn't, if it was trading it, you wouldn't just buy 2 shares of the stock. You would buy the 250 shares, right? So in our case, that could be 3 contracts, 8 contracts that we buy or short. And if it stops out, we lose $300. And if it wins, you make 600 or whatever your multiples are. Just wanted to be clear on that one. Now, this also applies to your personal account. A lot of traders who run their own money don't even have a stop loss. They're willing to take 10, 20, 50% drawdowns on their account like it's no big deal. Some people will just blow it up, get a $5,000 account, blow it up, and move on. No big deal. This takes the same, it's your own money. It's actually your money. So you should be a little bit more concerned about that. And if you're personally doing this right now, if you're trading your personal account, I would suggest one of the best things you could do is set a hard and fast stop loss percent level that you will never go below. Could be 2%, 5%, 10%, 25%, whatever it is. But just set it up so that that's what it is. And if you know your max consecutive losses, now you can actually size it correctly too. Like, imagine if you had a $25,000 account that you were willing to take a 50% drawdown on, you have $12,500 to trade with. That's 2.5 times what a prop account is. So even if you don't have a big enough account, consider joining a prop firm. That way you can get access to multiple 6-7 figure accounts. Okay. Once you've determined the level of risk when you'll stop trading, right? That down 3.3% or $5,000 in this example, either from the firm or your own rules, we can figure out how to use position sizing to meet your goals. And there are a few key pieces of information that you need to know about your trading system. Your win rate, kind of useful just to understand where you are, expectancy, and max consecutive losses. These 2 out of 3, but those 3 are super important. Win rate's important because you just want to know if you're like at a 20% win rate, okay, what's going on? Something might be off here, right? Your expectancy, which is something we'll get into here briefly in a second, and max consecutive losses. So your win rate is total number of trades divided by total wins, right? Expectancy is total dollar amount, which we now do in R because you know how to do R, divided by total number of trades. So let's say you've made 100 R and you've done 100 trades, your expectancy is 1. You did 200 trades, your expectancy is 0.5. Okay. And your max consecutive losses, we already covered that. Max, total losses in a row. Okay. Now, again, to reiterate, do your own manual back test, keep track of live trades on every asset you trade so that you know when you're live trading, you can compare it to your back test and your system and know where you are. Excuse me. Let's talk about my system, the Curvy system. I have a win rate around 60%. It's closer to 40 this week. Expectancy measured in R is 0.52. That's long-term. Both of these numbers are very long-term. I actually have a max consecutive losing trades of 9. These numbers manually backtested and coincide with my live trading results on a 10-minute chart using NASDAQ, SPOOs, corn, wheat, gold, crude, natty gas, treasuries, ultras, other symbols I've messed with too. Do your own manual backtesting on every single one so that you can confirm the results for you. If you're getting different results, maybe you're doing it differently and you need to adjust it. So let's talk about as a prop trader. I have a very strict rules that I must follow in exchange for getting a funding opportunity, right? Which is almost limitless. I can have 20, 30, 40, 50, whatever prop accounts and tie them all together and trade really big, large of money. Or I could have, a good track record and raise capital from other prop firms. There's a number of ways to do it. But we're going to talk about the retail prop management method right now on the $150,000 Apex account. So total max drawdown, 3.3%. That's this is an intraday peak, by the way, at Apex. At other firms, they have an end of day peak. That's something we'll get into in another video. Can hold no positions after 3 p.m. Central Standard Time and only trade on approved assets. So if I average 4 trades per day with a 0.52 R expectancy, that's 2.08 R per day, that's $624 a day using that $300 R measurement. 20 trading days in a month, that'll be 80 trades for the month. That means plus 41.6 R per month, or $12,480 in profit on the account. Okay. So if you know what your expectancy is and you're getting enough trades in, you should be able to guess what your returns will be by the end of the month. Some months you get, 20 or 30 trades instead of the 80. Some months you get 100 trades. So the expectancy may fluctuate a little bit, but you should have an idea of about where you are. Now, it plays out over time, and I can't state this enough. Over the course of the next 10 trades, that's not going to be obvious. In fact, you'll probably want to quit. Usually what happens when you start trading a new system, a new account, open a new prop account, or start trading a new style or something like that, the first 10 trades are, I don't know, just expect them to be crap. They may be the best trades of your entire existence, but most likely you're going to have 10 bad trades. Okay. But over the course of 100 or 1,000 or 10,000 trades, it's just a repeatable business. You can literally guess what your monthly returns should be, and you'll be fairly close, especially when you average it over the course of 12 months, 24 months. The month to month, the week to week, the day to day is where most traders get lost. And prop companies, they love those resets, they love those fees. So it's a target-rich environment with new traders. Okay, and this is what the first 10 trades look like. In fact, this is what probably my last week looks like. You could probably grab any given week or any couple of days, and it would look like that. But take it out over 100 period. So here you can see this literally was the first 100 or first 10 trades of that, and you can see it. It's up, down, down. And it took a little bit to get going, but it really took off. Once it really took off, there was no problems, right? But guess what? This looks like it really took off, but another period of happens. It happens. Know it. You have a system. But over the course of time, you won't even realize it. This same chart. This is 300 trades now, and just plugging right along. Things look fine. No issues there. The most important part of all this, once you understand your position size, once you understand your expectancy, once you understand all that risk parameters, that's all outsourced. You have a spreadsheet that handles that tells you how many contracts you trade, where to, you know where you put your stop and your profit target and all that stuff. That's all handled. It's up to you at this point in time for perfect execution of the system. Because you start making mistakes, that's when this, 52.52 expectancy starts dropping. That's when your max consecutive losses really starts to creep up. So I would rather make the mistakes, not make the mistakes, I should say, get really good at focusing on just implementing my system, knowing that I will be wrong on trades, knowing that, hey, here's a place to trade, jump in the trade. Oh, no trade there. Thanks. Bye. Knowing that all that is the case, I want to be in a position that over time, I can just take trade, and it'll work out. So trading is a business. Now, a lot of people think it's about predicting the future or any of that. But if you see here with a system and running it in this style, you should be able to know how much income you need to earn a full-time, to trade full-time. That means get rid of whatever other job you're doing, retire your spouse, or achieve X target, right? All this work we've put together, you should know how to put all that together. So in the example we talked about, you could earn about $12,000 a month with 150 prop account in goals, minus the profit split with the firm means you're making $99.84, about $10,000 a month. If you need $40,000 to retire you and your spouse or hit your targets or whatever, then you need a $600,000 prop account or $450,000 accounts, which you can be connected through trade copiers. You don't need to like do buy. You can use software to do it, which again, we'll get into in another session. So whether you take the scaled approach or open multiple accounts, meaning you could start with a $150,000 account and just slowly work your way up to having a $600,000 account, or you could open multiple accounts. That will determine, one thing, how long it'll take for you to get there, right? There's also firms that will hire you as an employee or a trader, right? You can get hired on a salary. You can get hired as a trainee, then no salary, but they give you all the training. And then within a year or two, you're expected to be profitable or things like that. And if you are already well-funded and not interested in prop, then risk management that we talked about here is even more useful for you, because this is what would make, a lifetime of successful trading. So I talked about the Curvy trading system. It's a mean reversion trading system. It can be used for swing trading too. It's not just for prop trading, but I did build it for intraday prop trading so that traders can pass their tryouts and stay funded. You can check it out, pollinatetrading.com/curvy. The discount code is prop50 for a 50% discount. And we do this all day, every day in the trading lab, pollinatetrading.com/lab. Prop traders, we are in there every day, taking our trades, sharing our trades, giving our thoughts, doing all this other stuff. Trading's lonely. You should join us, pollinatetrading.com/lab. You get a free month if you buy Curvy. So you can check out the lab too. All right, guys, let's end this. Thank you for everything. Again, like and subscribe. Do share it out to somebody who needs to see this. We want I'm tired of traders blowing up accounts, and I want people to win. pollinatetrading.com. I love you guys.